All right, let's welcome our next guest. Robert Schein is with us, Chief Investment Officer at Blanke Schein Wealth Management. Thank you for being with us. How are you feeling about the high yield environment? You know, we're getting some of the headlines from the Fed's beige book as well. We just had the 20-year auction, by the way, and that we saw strong demand. So that was some good news, especially after last week where there was an auction for bonds didn't go as well. So where do you think we're standing here in this high yield environment?
Well, the high yield environment, specifically the Treasury market, is providing competition for everything, for the equity market, even for the fixed income market. And so the alternative is there, even real estate. As we saw, Liz Ann Saunders, one of the best with Schwab, produced a chart that shows there's now competition because the yields are on the Treasury side, competition on the cap rates for real estate. But right now, currently, the market's still fixed on earnings. We're in earnings season. We're looking at growth, revisions, guidance, and valuation. Currently, 84%, even though we're early on with some of the banks and everything else, 84% of S&P 500 that have already reported have exceeded expectations. Valuations are still hanging in there, about 18 on the PE, on a forward PE, which is lower than the 5-year sort of average there. Not too many revisions. And the growth is actually there. We just saw growth in banks as well. So earnings is the story of the day, even though the 10-year Treasury and all of the yield curve has basically continues to move and march higher.
Tell me a little bit about some of the things you like and why they stand out to you. For example, you have PPA, the Investo Aerospace and Defense ETF. Is this a good group right now?
We believe absolutely. We've actually had this in our portfolio for our clients for quite some time. And the reality is it's a geopolitical hedge. PPA is a broad diversification by way of investing in defense contractors, by way of the top 10 U.S. defense names. Think Lockheed Martin and Raytheon. And so right now, when we have two wars, we're looking at Israel as well as the Ukraine, the defense contractors have one thing that Washington, dysfunctional Washington, can agree upon, which is both aid from both sides of the aisle. So we're going to see a lot more follow the money if you go through it, and it's going to follow its way to the defense contractors. So we use this as a geopolitical hedge. It's sort of a tactical asset allocation. Investors should consider this if they don't already have exposure to defense in their portfolios.
Understood. And how about energy? I mean, we've seen bond yields running up. Energy is running up, too. Right now, oil's at $88 a barrel, and the likelihood that it could go higher, especially with the wars you're talking about, it's a possibility, right? ETF of XLE, right? Is the name you're watching?
XLE is another broad-based approach to basically entertaining, adding energy into your portfolio. Again, let's look at it. Whether energy is at 88 today, we believe it's going to get it to 100 because tensions will persist. Traditionally, things get worse than they get better. At the same time, energy is under-owned and under-allocated, even in a weighting perspective in the S&P 500. It's already corrected earlier this year, so the valuations are there, and the growth rates are there too. So, oil companies can make money at 70. We don't need $80 a barrel for them to continue to make money. So it's a strong sort of wind in its sail, again, a geopolitical hedge as well.
Right, and most of the people I speak with say the path of least resistance here is to that $100 versus downward at this time. Last but not least, AI is still it. Even in this earnings season, next week we'll start to really kick off and see a lot of the Magnificent Seven and things like that. But, for example, Alphabet, Google is a name you like.
We like Google. Out of, let's say, the Magnificent Seven, it's one of the best sort of valuations, but it has AI as a play. Now, the cloud over Google right now happens to be the DOJ is coming after them. They want to break them up, some of the parts. Google wins either way. Whether they're broken up, they'll have sort of more valuation. Investors and analysts believe that's where you're going to see if that goes down the road. We don't believe Google's going to be broken up. All Google has to say in court is, listen, we're the best and we're going to be the best, but our second largest competitor to this is Bing as a search engine, which is Microsoft. The number one searched item on Bing is Google. So you go to Bing, you go type Google, you go back to Google, then you do your search. So I think they've got their case right there. They're great value right now, especially if you look long into the future.
What do you think of earnings season thus far? I know we're just in the beginning of it. This week, for example, we have 10% of the S&P 500. Next week, 40% of the S&P 500 will report. What are some of your takeaways thus far?
You're going to want to look at what the executives are actually saying. What's the impact on the U.S. consumer? Because at the end of the day, 75% of the U.S. economy is the U.S. consumer. So obviously some companies have the ability to navigate and pull some levers to sort of cost cutting. But ultimately, we want to know the pulse of the consumer. Are these long variable rates, lagging effects hurting the consumer? We believe they are. So we believe autos as well as housing is going to slow down and already feel it. We believe real-time data is going to show that. And that's what the earnings is going to come out and say. So I'd be keen to see how the consumer's holding up, because it's probably not going to hold up too much longer. So we're also defensively positioned in terms of adding treasuries to our client portfolios right now as well, even though we believe earnings will actually be better than expected.
But you do think it is going to impact the consumer. You mentioned autos, housing, some of these things that could see the slowing. Robert Schein, great to see you, and thank you for all of that. We really appreciate it. Blanke Schein Wealth Management. Thank you, Robert.